Hello, everybody. Welcome to Financial Modeling 101. This is going to be a very basic overview of how to do what's called a three-statement financial model. Starts with an income statement, goes to a cash flow statement, and ultimately a balance sheet. The ultimate purpose of this is when you're in the process of buying a business, you want to look at historically what's really been happening with cash flow, not what the broker's telling you, but what's really been happening with cash flow. It also is a good reminder as to whether or not the financial statements you've been given are accurate or not. Sometimes they are, sometimes they aren't. And then most importantly, as you go forward, you use this model to project what your future earnings are going to be, what your future cash flow is going to be, what your future balance sheet should look like. So with that, I'm going to share my screen and we're going to go right there. So this is the cash flow example. All right. So this is a hypothetical company, made it up, does not exist. All right. I modeled out 3 years here. Here's your 2021, 22, and 23. You'll see that the business has gone from $1 million a year in revenue to 3 million to 4 million. Doing pretty good. Cost of sales, if you look at that, it's a straight 40%. In fact, you can see that up here. This is the formula. So it's 40% of sales. I continue to have 40% of sales. Gross profit is how much money you have after you've paid for your cost of sales. So 600,000, 1,824,000. Operating expenses, simply expenses to operate the business. That's right. All right. Interest expense, you're going to find out here that in this acquisition, and this is kind of a post-acquisition, this is assumed that the company was acquired on December 31st, 2020. So these are the first 3 years of operation. Well, you've got interest expense here of $50,000. And we'll explain that in a second, but you'll see from the formula, it's 5% of a balance sheet number. So 5% of $1 million is 50,000. So we borrowed $1 million. Depreciation. That's going to come from our cash flow statement, but depreciation is a non-cash expense. And that's important because ultimately you're going to want to track cash. So you get this. This is pretty straightforward. You start out with $1 million business. You triple it the first year. That's awesome. Actually, the second year. Add another million the third year. Start out by making 100 grand. Now you're making 600. Now you're making almost 900. Looking good. So how does this work? So here's the cash flow statement. Now, this looks more complicated than it is. All right, I'm going to spend a little bit of time right here at the end of 2020. This is when you bought the business. Okay, we're assuming you bought the assets of a business. You bought $100,000 of accounts receivable. So that minus 100 means you had $100,000 of cash going out. You bought $500,000 of inventory. And CFO simply means cash flow from operations. Cash flow from operations, CFO. So the one way to look at this is how much is the enterprise actually producing in cash for you? All right. 2020, you're just buying this, so you used 600,000. Now you bought another $1 million worth of property, plant, and equipment. So in total, you're paying $1.6 million for this business. And then and so this is CFI, cash flow from investing. And you'll notice here You invested 50,000 the first year of operations, $25,000 each after that. That's cash going out to some sort of capital spending. It could be a vehicle, it could be leasehold improvement, could be anything. But that's what we're assuming you're spending in years one, two, and three. So how did you pay for this 1.6 million? Well, you got a bank debt, long-term debt at for $1 million, and you invested $600,000. All right, so that's the 1,600,000. You bring in 1,600,000 between debt and your equity, and 1,600,000 goes out, and there's no cash left. Again, very simplistic. Would you buy a business under these terms? No, you wouldn't. I mean, obviously, you need cash on day one. But again, very simplistic because I want to teach you how to create these models. All right. So let's go to the balance sheet. What's the balance sheet look like at the end of 2020? You just bought the business. We showed you that you paid 100,000 for receivables, 500,000 for inventory, and here you go. Here's your 100,000. Here's your 500,000. Current assets of 600,000. You bought $1 million in property, plant, and equipment. Total of 1,600,000. Long-term debt, equity 1.6. So this is where we started. All right. So what happens next? So we go into this first year of operation, and we do $1 million in sales, and at the end of the day, we make 100 grand. So how much cash did you actually produce? How much cash did the business actually produce? Well, that's why we go to the cash flow. Here's your net income. Here's the depreciation. And the question becomes, oh, wait, time out. Why are we adding back depreciation? We're adding it back because it's a non-cash expense. So you've actually created $200,000 in cash. Going down here, we see that our receivable level started out at 100,000, didn't change in 2021. It's still 100,000. So you've not used any cash, and nor have you created any cash. So think of it this way: if your accounts receivable went from 100 to 150, you've actually used $50,000 in cash, and that's what we have in 2022. It went from 100 to 150. 2023, we added 75 more. It's going to 225,000. And all of that is a use of cash. All right. If you didn't have those receivables, you'd have cash. So it's future cash. So you've used cash to get there. Inventory. In 2021, you grew your inventory, increased it by 50,000, and then increased it by 100,000 as you really started growing this business, and then increased it by 200,000. So your initial 500,000 in inventory goes to 550, 650, 850. We'll see that in a minute. Now, if you notice, when we started out here, there was no accounts payable. Accounts payable is what you owe somebody else. And if you grow your accounts payable, if they go up, effectively you're generating cash. And you're saying, wait a second, time out. How is that? Well, if we go back to the income statement, 2021, we said your cost of sales is $400,000. Now, what if you only paid your suppliers $300,000? You still owe them the next 100, right? That's an increase in your payables. But instead of having $400,000 in cash going out of the business, you just have $300,000 going out of the business. Therefore, you generated another $100,000 in cash by effectively not paying your bills at 100%. So the cash flow from operations that first year is 250 grand. Now, if you look back up here as the following years, remember, all of a sudden you're going from a million to 3 million to 4 million. And here's your income, 100 grand to 600 grand to 800 grand with $100,000 depreciation each year. So down here, what you're doing is you're growing your accounts payable as the business grows, which is normal. You're growing your inventory as the business grows, which is normal. You're growing your receivables, which is normal. Right? As the business gets bigger and bigger and bigger, you'll have more receivables, you have more inventory, you have more accounts payable. Does that make sense? We add this up in your cash flow from operations. Think of this as the cash flow you've actually generated in the business. It's 250. Then it goes to 660, and then it goes to 895. All right. Down here, you have cash flow from investing. We talked a little bit about this before. First year, you're going to put $50,000. Next year is $25,000 a piece. So the rest of your cash flow, you have all this cash coming in, but you also have cash going out. You have long-term debt. Well, the long-term debt was structured as a 5-year loan. Every year you pay back $200,000 for 5 years. So you pay your interest based on the total of the loan at the end of the first year. You write the bank a check for $200,000. Understood? So in this case, after the first year, you've generated 250,000 in cash. You used 50 of that to buy additional plant and equipment, and you used 200 of that to pay off the bank. The next year, you created 660,000. You only used 25,000 for CapEx. Here you used $200,000 to pay down debt, and you decided, hey, I want some of that, and you paid yourself $100,000. So this is a distribution to you as the shareholder. So in total, you used 325,000. You've got additional cash of 335,000. Next year, you do the same thing. In fact, why don't I change this? This year, you're probably going to want 250,000 as a bonus because you're such a good guy. Boom. So now, there we go. Got the make sure the formulas are right there. Now you generated 895. You used 25 of that. You've got 870 left. You used 450 between the bank and yourself, and guess what? You added another $400,000 in cash to the balance sheet. So you see how this flows together. The P&L, the income, goes to the cash flow. You figure out all the components of cash flow, and that's going to go to your balance sheet. So we started here in 2020. The first year, what we say? Well, there's no net cash flow. You generated 250, you used 250. Sure enough, here you go. Accounts receivable was unchanged, but remember, you invested 50,000 in inventory. So it goes up. And the formula for that, would be this. I mean, I didn't put that into a formula, but there it is right there. If you take your previous, I'll just copy this over. So you take your your D7, previous inventory, and you subtract your cash flow here. So it adds 100,000 in inventory. So in total, your current assets are now up to 1,135,000, including the 335 in cash. Remember, Down here, you're 335 in cash. Your property, plant, and equipment is increased by $50,000 in 21, 25,000 in 22, and another 25,000 in 23. And for simplicity, we're just keeping the depreciation the same at 100,000. So cumulative, you're now at 200,000, and now you're at 300,000. If you go down to your payables, you remember we started out with no payables. We added $100,000 in 21, added another 120,000 in 100,000 in 22, and then 200,000 in 23. So that's money you owe somebody. Your debt, remember we're paying off $200,000 a year. Your debt goes from 1 million to 800 to 600 to 400. If we were to go out 2 more years, it'd go to zero. Your shareholder equity started out at 600, goes to 700, goes to 1,200,000, goes to 2 million. And that's even after you've taken out $350,000 in cash. Pretty cool, right? So your $600,000 investment 3 years later is worth, not worth, but it is, on your books at almost 2.1 million. And in addition, you've taken out 350,000. I'll take that back. A little problem with the math there. Because assets always equal liability. So you've tripled your net worth from 600 to 1,800,000, and you've taken out $350,000 in cash. All right. So if you understand that, you're starting with income statement, it flows through to your cash flow statement, right? And then it flows through to your balance sheet. Pretty cool. So that's how that works. I'm Jeff Bilwach, the acquisitions professor.